Good morning and welcome to the Killik & Co market update. Retail sales data has been in focus this week and we're getting a feel for how retailers performed in that all-important Christmas season. Unfortunately, UK retail sales data came in below expectations. Here we've got the annual change in the volume of retail sales each year for the last 10 calendar years, and we've now had 2 consecutive years of UK retail sales falling in volume terms. And this will largely be because inflation has been high and therefore people have been spending more but ending up with less. Apparently people spent 13.8% more in December 2023 than they did in February 2020 just before COVID, but they ended up with 4.8% less. So this data clearly shows that people's quality of life has declined, and this will present a problem for the government in the run-up for this year's general election. Our Chancellor Jeremy Hunt gave a speech at the current economic forum in Davos, and he did hint that there might be some tax cuts on the way in his spring budget, which is currently scheduled for March. The retail sales data for the US has also been published this week, and it showed a much more positive picture. Here's the monthly data over 20 years, and you can see there was a steady increase throughout 2023. On this chart, we can see what happened to retail sales following the financial crisis in 2009 and how this compares to COVID times. Another piece of data that beat expectations in the US this week was jobless claims. Jobless claims are often viewed as a proxy for company layoffs, so a low number of jobless claims indicates a healthy US economy. Here are jobless claims over the last 2 years, and you can see a clear downward trend over the last 6 months. And just for interest, I've also got the 20-year chart here, and you can see that massive spike when so many people couldn't go to work because of lockdown. These 2 strong bits of data suggest that the US economy is doing pretty well, and that implies that it could withstand higher interest rates for a longer period of time. And therefore this week we have seen a change in when US interest rates are expected to start falling. A company called CME publishes something called its Fed Watch tool, which looks at how investors are trading the markets, and it uses this to work out when these traders are expecting interest rates to move. Here are the current implications. The dates of all the planned Federal Reserve meetings are down the left-hand side, and the top row shows interest rates. Whereas the UK has a precise interest rate, currently 5.25%, the US targets a range, currently 525 to 550 basis points, as you can see by that green box. The percentages show the likelihood of rates being at a particular level after a particular Fed meeting. For example, there's a 97% chance that rates will still be at their current level after the meeting on the 31st of January. And there's a 56% chance that rates will be 25 basis points lower after the meeting on the 20th of March. These numbers are constantly changing, and you can check them yourself by Googling the CME Fed Watch tool. And finally this week, we've had some results out from some of the big US banks. US banks have been benefiting this year from higher interest rates because this enables them to charge more on loans. JP Morgan has just published a record net profit figure of just under $50 billion. It's interesting to look at just how big JP Morgan has become. Here are the market capitalizations of some of the big US banks. JP Morgan, $479 billion, Wells Fargo, much smaller at $168 billion, Goldman Sachs, $122 billion, and Citigroup, $97 billion. Because JP Morgan now controls more than 10% of all US banking deposits, it's not allowed to acquire any other banks unless that transaction counts as an emergency transaction. So the troubles for the banking sector that happened at the start of last year actually benefited JP Morgan. These were the troubles that were triggered by the collapse of Silicon Valley Bank. When First Republic Bank got into trouble after that, JP Morgan was allowed to acquire it because that counted as an emergency transaction. Here's a comparison of the share prices of these big 4 banks over the last 10 years, and you can see JP Morgan well ahead of the pack in the pink there. Jamie Dimon, the chairman and chief executive of JP Morgan, is a well-respected figure in the industry, and it is well worth listening to his thoughts on the wider economy. So here are some comments of his that we've picked out of the latest set of results. Firstly, he says that the US economy continues to be resilient with consumers still spending, but he does have a couple of warnings. He does say there is also an ongoing need for increased spending due to the green economy, the restructuring of global supply chains, higher military spending and rising healthcare costs, and that this may lead to inflation being stickier and rates being higher than markets expect. And then finally, he says that the ongoing wars in Ukraine and the Middle East have the potential to disrupt energy and food markets, migration, and military and economic relationships. So these are all things that we at Killik are also very mindful of at the moment. Moving on to have a look at next week, it's getting quite busy on the corporate calendar, and we are expecting results out from Netflix, Visa, and LVMH. That's it from us. Have a great weekend, and we'll see you next Friday.